Hello everybody, my name is Craig Bennett, and today we're going to get into another stock market video. In this one, we're going to get into dividends. Now, as far as this goes, you might have think that this, especially if you're more advanced, might think it's a little bit weird that I'm getting into the dividends within this portion of the course. But I think it's important to note when you're doing your research into stocks to buy and sell and stuff like that, that what is the dividends for the companies. Basically, if you don't know what a dividend is, all it is that you need to know on your end is when a company gets a excess amount of money, either quarterly or yearly, what would end up happening is they have a choice of putting it right back into their company, which is a smart option overall, or they have a choice of if they're on the stock market to put it into the shareholders, and this is the dividends. So basically, what would end up happening is, let's just keep the math easy. And what would end up happening is, let's say there's 50 shares across the board, entire company. Again, keep the math easy. And the company made $100 extra for that year. Well, what they'll need to do is, if they want to give that $100 to those 50 shares, is it's divide 100 divided by 50, and that's 2. So with that, basically, each share gets $2. So if you own one share, then you get $2. But if you own 2 shares, you get $4, and so on, and so on, and so on. Now, the thing that you need to know as a trader, especially if you're not going to go too deep into dividends, is by having a stock that is getting a dividend, you need to meet one criteria. You need to simply own the stock during the time that they are given the dividend. Simple as that. Now, what would end up happening is there's a few things that can happen. One, like I said before, they will give you cash, flat out cash. A second, and this is a highly unlikely, but it is still possible, that they might give you dividends in form of extra stock. So what this gives you is selling power, extra selling power. So when you do end up selling your stuff, you'll have more. It might be a percentage of a share or something like that, but still it'll be a little bit more. But and I've seen that I think once or twice, but I've seen more than not the cash. It's better all around to do cash. So what ends up happening is when a dividend is given out, it will show up in your account. So let's say that example before, maybe you own a share and you're getting $2. So what would end up happening is $2 will go in your account. Does that mean that you need to keep the stock after that? No. Does it mean that you need to keep the stock when you get that? Yes. You need to have the stock in order for them to give it to you. That's simple as that. And obviously, the more you have, the more money you'll get. But with that one in mind, after you get that, there's no obligation to keep the stock. There's no obligation that you maybe you bought the stock a day before. They'll still give it to you, just as if you bought the stock a quarter back of 3 months back. The fact is you just need a stock for that one instance when they're giving it the dividends out. After that point, you get the money in your account, or you get the extra shares, and you can sell it, fine, all whatever, and from there you can do whatever you want. The thing that the companies would like you to do, and the reason why they're giving you the dividends in the first place, is that obviously the more money that you invest into them, the more money you'll get out with the dividends, and that way you can actually take the dividends and invest right back into the company. but it gives you more of a reason to hold on to that stock for longer periods of time. Now, as far as that goes, going a little bit further into it, there is something called a dividend yield, and this is fairly important if you want to get a little bit more advanced into this. So basically, what happens with a dividend yield, and I'll give you the simple math formula for it, is the annual dividend per share. And by the way, you can look up the highest paying companies, highest dividend companies in a given market, and that way you can see the yields and stuff. But basically, how the yield is found out is the annual dividend per share divided by the price per share. So basically, what you need to keep in mind with this is, let's say you have two options, right? And this is a very simple explanation. One stock is at $20. The next stock is at $40. Both stocks give $1 per share towards the share owners and their dividends per the annual. Well, what ends up happening is the dividend yield is basically you divide the annual share, so $1, between the stock price, so one being $20, the other one being $40. Which one's going to have the highest yield? It's the lowest cost one. Basically, the $20 one, it's at a 5%, while the $40 one is at a 2.5%. This is fairly important to note because basically all it's saying is how much money, how much buying power do you have? At a 5%, basically it means that you can actually buy more stock because, again, it's $20. Both of them give the same annual dividend, just to keep math easy, but you can buy more than $20, and that means that you can actually get more out of it. Versus the 40, you can only buy half of whatever you can get with 20. And this is fairly important when you're looking at the dividend stuff. But again, there's lists and stuff like that, so you don't have to do the calculations throughout. So you can just go to some websites and they'll already have the calculations and stuff already done for you and showing you the companies that has the highest yield. And that's something that you got to keep in mind. Now, the biggest thing is, why isn't all companies competing against each other for the dividend yield, trying to have the highest yield as possible? Well, there's a few things. One, dividends are not a guarantee. The fact is like I said at the start, the company needs to have an excess amount of funds. Maybe, and it has to go into the shareholders. All right. So what would end up happening is if they get access and they're going to put it right back into the company for whatever reason, well, the fact is you're not going to get anything. Or let's say that they go under expectations or just at expectations. Well, the fact is you're probably not going to get anything there too. So with that in mind, there is no guarantee you're going to get any dividends at all. That's a big one right there. And the reason why the companies don't, like throwing that out, the reason why companies don't compete against each other for dividend yield prices is simply a company that is more tradable, meaning that the how volatile it is as far as how much it can go up and whatever. Well, basically the dividend yield is going to be lowered dramatically. In fact, many companies don't have any dividend yield simply because it doesn't give out any dividends, simply because that their trade amount is so high, and they're able, and it just keeps going up. It's not a static price. So with that one in mind, if a company does not trade a lot or is just simply it's almost static, you're probably going to see some a fairly high dividend yield because You're not going to see a lot of trading action from people like myself or some other people that you do want. And basically, this ensures that some people will keep their stocks there, and long-term investors will have a reason to invest there over other places. And while as people like myself, where we can get a higher amount of money in a short amount of time, which means a higher amount of money overall, the fact is we wouldn't normally go to those places unless if going on vacation or quitting for a few years or something like that. But other than that, normally wouldn't put too much effort in for the dividends, simply because there's other places that have a higher rate of being tradable. So as far as that goes, that's just something to keep in mind. Why should you keep an eye out for dividends? It's free money. It's basically what you're looking out for is a few things. First off is the price, history. It's fairly important. If there's no history of a company given quarterly or annually, then the fact is they're probably not going to give it out in the future. So price is a major thing because you got to be able to afford it. The price that they give out, how often they give out, and if it's a reliable as far as it given out, or it's just one time before or very, very recently and that's it. So those are things that you have to keep in mind when you're searching for dividends or when you run across a company that gives dividends. You might want to keep that in mind so you know what you're looking at. But anyways, as far as that goes, hope that has helped to explain things, and hopefully it explains things for future videos and helps you out while we go into research and how to read charts and whatever. But if you got any questions, feel free to let me know, and I'll try and answer it quick as possible.